The IRS just released new guidance about using LikeKind Exchange for cryptocurrency. If you were trading crypto prior to 2018, this applies to you, so keep watching. Previously, the IRS stated that LikeKind Exchange treatment could not apply from 2018 onward, but a lot of people still have questions about prior years. This new guidance states that even prior to 2018, LikeKind Exchange does not apply to crypto. I'm Andrew Gordon, a crypto tax lawyer and CPA. Let's talk about the background of LikeKind Exchange treatment and what the new IRS guidance means. So, for starters, crypto is treated like property for tax purposes, very similar to the way that stocks are taxed. Because of that, trading one type of crypto for another, for example, Bitcoin to Litecoin, is treated as if you sold the Bitcoin for cash and then used the cash to buy Litecoin. So that sale of Bitcoin for cash is something that needs to be reported. If you made money on that sale, you have capital gains. But even if you lost money, it still needs to be reported. You can imagine how much of a headache that is when you're doing hundreds or even thousands of crypto trades in a year. Even worse, a lot of people don't realize that these crypto to crypto trades are taxable, so they end up owing a lot of tax that they didn't expect. The next question that always comes up is, well, what about LikeKind Exchange? LikeKind Exchange is a tax position you could take in some situations, which, if it worked, would make that sale of Bitcoin non-taxable. The IRS previously stated that LikeKind Exchange does not apply from 2018 onward. Until recently, prior to 2018 was up in the air, but the IRS finally clarified that LikeKind Exchange won't work for any year when it comes to crypto. Before the IRS released this new guidance, I saw some professionals promoting the use of LikeKind Exchange treatment prior to 2018. If that argument worked, it would save a lot of money on taxes for their clients. But at my firm, we've never been convinced. In fact, we consider LikeKind Exchange such a poor stance to take on crypto taxes that we wouldn't do it. You can watch my old videos to see the two reasons why. I'll put a link in the description. But in general, we tend to take a more conservative approach with crypto taxes. Because we're tax lawyers, we defend people in audits and investigations, and we practice offshore tax law. We see what can go wrong. Even though the IRS has been slow to release specific guidance about crypto taxes, we know how they operate and we can predict pretty well what they will say when they finally do release guidance. And we take a lot of pride in making sure our crypto tax returns are bulletproof, meaning that if one of our clients gets audited, their tax return will hold up to IRS scrutiny. This LikeKind Exchange treatment is a perfect example. The IRS finally came out and said that LikeKind Exchange doesn't apply, even before 2018. Since we've never suggested taking that position, our clients have nothing to worry about. So what if you've submitted a crypto tax return that did use LikeKind Exchange treatment? It could get you into trouble. If you were audited, for example, then the IRS would not accept that treatment and they'd say you owe additional tax. When that happens, they also apply penalties, anywhere from 20 to 70%. If you relied on the advice of a tax professional who told you that LikeKind Exchange would be okay, you may have a reasonable cause to get penalties removed. You can give my office a call to discuss that. I'll put my phone number down in the description. If you are risk averse, you may want to amend your tax returns now rather than wait to get audited later. I'm happy to help guide you through all the different options that are available. If you like this video and this information is useful to you, please hit the thumbs up button and hit subscribe. I really appreciate all of that. Thank you for watching and comment below with any questions.